Today we will be going over the taxable income formula. In other words, briefly, how is taxable income calculated? So as a recap, taxable income is the amount of income that the IRS subjects to tax. You could have $80,000 in income, but if your taxable income is only $60,000 of the $80,000, then $60,000 of your $80,000 is subject to tax, while the other $20,000 is what's called tax-free. So let's get started with how to calculate taxable income. So first we start off with income. Remember that from part 1 in this series, that income is all of a taxpayer's income, both taxable and non-taxable. So income includes the non-taxable portion and can be regarded as any increase in wealth. From there, we have to subtract what's called exclusions to arrive us at gross income. So gross income is income minus exclusions. Now what are exclusions? Exclusions are specifically designated areas of a taxpayer's income that the IRS deems to be non-taxable. So an example of an exclusion is gift money. If your parents give you $10,000 as a gift, this is an exclusion because the IRS says that this is not taxable. So if your total income is $80,000, in which $70,000 of it is from your work as an accountant, let's say that's your job, and $10,000 is from a gift from your parents, then yes, your total income is $80,000. But your gross income is only $70,000 because the $10,000 gift is an exclusion that will be subtracted from your income. And this is because income can include both taxable and non-taxable income, whereas gross income only includes the taxable portion of your income. Since the $10,000 gift is an exclusion and is not taxable, then when you go to compute gross income, which only includes the taxable portion, you have to remove the non-taxable portion, and in this case that includes the $10,000 gift. And you can check out part 3 of this series for more information and examples on exclusions. Okay, so now that we've arrived at gross income, we subtract what's called deductions for AGI, which is short for adjusted gross income, to arrive at adjusted gross income. So deductions are expenses that the IRS allows you to use to reduce your taxable income. And one of these deductions are deductions for AGI. Specifically, deductions for AGI help you reduce your adjusted gross income. An example of a deduction for AGI is a contribution to a health savings account. The amount that you contribute to a health savings account, which is subject to limitations though, is an expense, right? Because you have to pay money to put money into this HSA. But it can be used as a deduction that reduces your taxable income. We can see from this formula too, right, that clearly deductions for AGI are reducing our taxable income because we're subtracting this amount from our AGI in the process of getting to taxable income. And you can check out part 6 of this series for examples of deductions for AGI and part 5 for a brief overview of what deductions for AGI are. So now that we've arrived at adjusted gross income, from here we can take either the greater of total itemized deductions or the standard deduction, whichever one is greater, and we subtract that from our adjusted gross income. Now why do we say whichever one is greater? Well, because remember, itemized and standard deductions are two different deductions that we can take to reduce our taxable income. But they're both deductions. Remember, the purpose of deductions is to reduce our taxable income. But not all deductions are created equal. If you have a deduction worth $1,000 and another deduction worth $5,000 and you can only take one of them, clearly you're going to take the deduction worth $5,000 because it'll allow you to subtract more from your taxable income, thereby reducing your taxable income by more, and as a result you get to pay less taxes because the income of yours that is taxable, your taxable income, is less now. So the IRS lets you take either the itemized deduction or the standard deduction, but you cannot take both of them. If you take the itemized deduction, you can't take the standard deduction, and vice versa. So you choose whichever deduction is greater in amount. I'll cover itemized and standard deductions in the next part of this series. You can also subtract what's called a deduction for QBI, Qualified Business Income, which I will also go over in a future video. But as a brief introduction, most taxpayers cannot claim this deduction anyways because this deduction is only eligible for those who own a small business. So for those who don't, sorry, you're out of luck. We can just ignore this deduction from the equation for those who don't own a small business. And after we've done all that, we finally arrive at our wanted figure of taxable income. Now, if you take a look at Form 1040, which is the individual income tax reporting form in the United States, you can kind of see the gist of this formula at play. Of course, it's not going to be laid out exactly like it is from this formula, where you can simply just enter your income, enter your gross income, enter your adjusted gross income, and so on and so forth. But you will see many of these figures appear in the form and the structure of it at play.